5 out of 7 speakers are right at the same time. When consensus gets this tight, the move accelerates. Right now, the S&P 500 is at 7,445.7, the 99th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection, says the data needs to confirm. The commodity analyst says we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this week. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The commodity analyst's commodity supercycle call is paying off. Oil at $98.2 and trending their direction. 153-day streak. Snyder is right, and the data keeps proving it. Yield curve at 0.49%. 3 days running, Gammon just moved from wrong to right. Gammon called it, credit will blow out. Investment grade spread at 75 basis points confirms it. The dollar analyst just moved from early to right. Score 1 for the dollar analyst. Dollar milkshake higher. Gold agrees at $4,516. The volatility expert just moved from wrong to right. The volatility expert called it volatility expansion. VIX at 17.4 confirms it. McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 152-day streak. Hartman is waiting on confirmation. The narrative holds, but the data has not validated it yet. 146-day streak. Score today. 5 right, 2 early, 0 wrong. When consensus gets this tight, moves accelerate. Stay positioned. Today's big question, are commodities in a supercycle, or is this the top? On one side says, the data needs to confirm. That is the setup. Everyone hears it on the podcast, it sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here is what makes this interesting. Oil is rising while gold is falling. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $98.2, 90th percentile, up 1.9% today. Gold at $4,516. 65th percentile, down 0.5% today. Copper at $6.34, 98th percentile, up $1.34, 98th percentile, up 1.3% today. Bottom line, the data is split. Neither side has a clear edge, which means the resolution is coming soon. If oil drops below $80, the supercycle call is in trouble. Right now, it is at $98.2. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $98.2 is in the 90th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,516. We'll track it daily on the scoreboard. None of the 7 are talking about this next signal, and they should be. 2-year yield just dropped 2.2% to 4.04%. A move this size demands attention. Historically, the 2-year at this level reflects where the market thinks the Fed goes next. None of the 7 are talking about this. Keep it on your radar. 10-year yield just dropped 2.1% to 4.57%. A move this size demands attention. Historically, the 10-year at this level reprices every leveraged asset in the economy. And here is another signal flying under the radar that deserves your attention. Phase 1 is the good times, but good times do not last forever. Here is how close we are to the edge. We are 75 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 75 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has initial jobless claims, copper-gold ratio flashing red. Snyder says the euro-dollar system is tightening and nobody sees it. The data agrees with that assessment. Phase 1 holds with 75 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here's what the ZIP level data is screaming about today. East Carroll, LA, lenders are saying no at scale. In East Carroll, LA, the HMDA denial rate is 67.1% across 70 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. Harlan, KY, lenders are saying no at scale. In Harlan, KY, the HMDA denial rate is 67.1% across 292 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. NC, days on market is collapsing in Charlotte. Days on market in Charlotte moved 99% in 30 days, now 36 days. Buyer leverage score 36-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Copper at $6.34 is in the 98th percentile. That means it is higher than 98 out of 100 days in the past year. In 2022, copper dropped 35% on China lockdowns and global recession fears. In 2020, copper crashed in March, then doubled over the next year on stimulus demand. In 2011, copper peaked above 4.60, then gave back 30% as China growth slowed. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, oil at $98.2 is in the 90th percentile. The last time both copper and oil were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. History does not pick a winner here, but it does say the resolution is coming soon. Be positioned before it arrives. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.4% today. Fast moves demand attention. Avoid Phoenix at 41% payment burden. That is stretched territory. Watch 2-year yield. It dropped 2.2% and nobody is talking about it. 5 out of 7 speakers are right. The commodity analyst, Snyder, Gammon, the dollar analyst, and the volatility expert. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. The talking heads give you opinions. We give you the numbers. Subscribe and I will see you tomorrow morning with a fresh scoreboard.